Hello everyone, my name is Magdi Hassan. I'm a certified public accountant CPA and a chartered global management accountant CGMA. I'm conducting this session as part of my commitment to social accountability and my ongoing effort to support CPA candidates. I also plan to host more sessions like this in the future. In today's session, we'll explore the topic of financial statements, beginning with the statement of financial position. Thank you for watching. Before we begin discussing today's topic, I would like to clarify that there is more than one set of accounting standards used around the world. GAAP, GAAP, stands for Generally Accepted Accounting Principles, which are applied in the United States. IFRS stands for International Financial Reporting Standards, adopted by over 140 countries globally, including Canada, the UK, India, and most of Europe. EAS refers to Egyptian accounting standards which are applied within Egypt. In today's presentation, we will approach our topic from the perspective of Generally Accepted Accounting Principles, GAAP. A complete set of GAAP financial statements include the following 5 reports. Balance sheet, or we may call it a statement of financial position. Income statement, a statement of comprehensive income, a statement of cash flows, a statement of changes in equity. Before we begin reviewing the balance sheet, let's refresh our understanding of the fundamental accounting equation. Assets equals liabilities plus equity. On the left side, we have assets. These are the resources owned by the entity that are expected to generate future economic benefit. On the right side, we have liabilities and equity that represents the financial structure of the entity or how the entity finances its assets. When an entity acquires assets, it must finance them through one of two sources. Liabilities, by borrowing from banks or obtaining credit from suppliers, or equity, by issuing shares. At any given point in time, the total value of assets will always equals the sum of liabilities and equity. Example, let's say an entity purchases assets with 10 million. It issues 4 million in shareholders' equity. The remaining 6 million is financed through liabilities such as bank loans or supplier credit facilities. So the equation holds: assets 10 million, equity 4 million, liabilities 6 million. This is an example of a balance sheet presented in accordance with GAAP. The balance sheet is structured with 2 columns, one for the previous year and one for the current year. This allows for easy year-over-year comparison. The balance sheet is divided into 2 sides, The left side represents assets, the right side represents liabilities and equity. The layout reflects the fundamental accounting equation: assets equals liabilities plus equity. Assets are categorized into two main types: current assets and non-current assets. Current assets expected to be converted into cash or used within 1 year or during the normal operating cycle of the business. The operating cycle of the business refers to the average time between the acquisition of resources and the final receipt of cash from sales. Non-current assets, long-term assets, or resources not expected to be liquidated or consumed within 1 year or during the operating cycle of the business. Current assets are arranged in the order of liquidity, with the most liquid assets listed first, followed by those that are less liquid. Now, let's focus more closely on current assets. In the previous slide, we introduced the concept. Here, we'll elaborate further. Current assets typically include several key components. The first item we'll review is cash and cash equivalents. This category includes physical cash, bank balances, cash equivalent, which is highly liquid investment like treasury bills. These assets are readily available and can be quickly converted into cash, making them essential for managing day-to-day operations and ensuring liquidity. Now, we'll move on to item number 2, certain individual investments. These investments in debt and equity securities are categorized into 3 classifications under the financial reporting standard. Held to maturity. These are debt securities that the company intends and is able to hold until maturity. They are typically classified as non-current assets unless they mature within 1 year. Trading securities. These includes both debt and equity securities that are purchased primarily for short-term resale. They almost always classified as current assets. Available for sale securities. This can be either debt or equity securities that are not classified as held to maturity or trading securities. Their classification depends on the company's intent and the maturity of the investment. For example, a bond maturing 9 months would be classified as a current asset, while a bond maturing in 3 years would be considered as non-current asset. Let's move on. We still have more items to cover under current assets. Third item is receivables. Receivables represent the amount owed to the entity by customers and the other parties for goods sold or services rendered on credit. These are expected to be collected within the operating cycle or within 1 year. Notes receivable. They are written promises to pay a specific amount of money at a future date. These are typically documented through a promissory note which includes terms such as interest rate, maturity date, and payment schedule. Inventories. Inventories consist of goods held for sale or material used in the production process. This includes raw materials, work in progress, and finished goods. Prepaid expenses are payments made in advance for goods or services to be received in the future. Although they are not cash, they are classified as current assets because they will be consumed or expire within 1 year.